Dividend traps or yield traps can be explained as stocks or ETFs, of course, that are both cutting their dividends and their stock price has fallen as a result. So the market hasn't necessarily expected the cut in dividends, and so their stock price falls. Now these days you don't even need to look all that hard throughout the stock market to find different stocks and of course ETFs that could definitely be considered yield traps. Like for example, something like TSLY, the Yield Max Tesla Option Income Strategy ETF, which utilizes a synthetic covered call strategy with Tesla stock. And even though TSLY has like a 50+% dividend yield, TSLY on the max time frame is down 54.67%, which means even with those massive dividends, an investor would have been better off basically just holding on to their money and not buying anything. Now in this video, we're going to go over 3 different high yielding ETFs that offer much higher than average dividend yields, but are not considered yield traps. Now, if you're a dividend style investor looking for massive income generation, stick around because you are not going to want to miss out on these 3 awesome ETFs. I just finished my brand new dividend investing ebook where I share exactly how I went from 0 to now over 7 figures invested, and also on how I earned more than $6,000 per month in dividends. I also finished my custom dividend tracker that you can use to track your dividend income progress on an ongoing basis. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. The first super high yielding dividend ETF that offers a massive dividend yield, but I personally would not consider a yield trap, is SVOL, or the Simplified Volatility Premium ETF. Now SVOL has an interesting strategy. It basically shorts the volatility index and earns a ton of premium for doing so. But as you can see, over the last 365 days, SVOL is up 1.19%, and a lot of you guys might be saying, well, that's not that great of a return. But considering SVOL has a 16.29% dividend yield, that side note, dividends are paid monthly for SVOL. This ETF has a good total return historically. Now looking at all of SVOL's dividends paid so far since the ETF's inception, over the last years the dividend has went down a tad on a monthly basis, but overall I still would not consider SVOL by any means a yield trap. So much so to the point that if an investor was to ask me, for example, what is my number one buy and hold ETF that's say above 10, 12, 15% starting dividend yield, I would simply respond with SVOL, and although this ETF is not necessarily perfect by any means, it's definitely an ETF to look into. Now the next high yielding ETF that definitely is not a yield trap in my opinion is JEPQ, or the JP Morgan Nasdaq Equity Premium Income ETF. Now JEPQ, a lot like other covered call ETFs, buys a basket of holdings and then sells covered calls along with it. Now, the reason I'm a huge fan of JEPQ, and side note, I even just bought a ton of JEPQ as of recently, this ETF has performed pretty good over multiple time frames, and this is without even including the massive dividend. JEPQ has returned around 6.5%, 7% on the max time frame, but on the last year, JEPQ has been on a tear up around 22%, which is super impressive. But along with that price return, at least so far this year, JEPQ also offers around a 9.7% trailing 12-month dividend yield, which is of course much higher than you're going to get across most stocks and most ETFs in the market. And because JEPQ is a covered call ETF, the dividends are going to be different over time. And pretty much across the board, you're not going to get the same exact dividend on a monthly basis when it comes to this style of investment. But JEPQ's dividends have been pretty consistent, and like I showed you a second ago, around a 10% yield with some super impressive price return, which in my opinion definitely makes a case that JEPQ is far from a dividend trap. Now the next super high yielding ETF that I don't think, at least so far I don't think, is a dividend trap is SPYI, or the NEOS S&P 500 High Income ETF. Now on the max time frame, we don't have all that much data to go off of, but SPYI is basically trading flat with where it was around 2 years ago. Now that might sound a little bit weird to some of you guys that aren't necessarily deep in the world of high yield investing, but trust me, a lot of these higher yielding investment vehicles offer massive dividends, but trade down and down and down, which I'm going to show you some more examples here in a second. So if you can find an ETF like this one, for example, that over the past few years has traded mostly sideways, that's definitely a win-win for higher dividend investors. Now, SPYI has a pretty interesting strategy. I've went over exactly what it is on other videos on my channel, so definitely take a look if you want to learn a little bit deeper about SPYI. But the ETF, like I showed you, has a decent price performance, at least again for a higher yielding ETF, and the dividend yields around 11.8% trailing 12 months. So at least so far, every single month, SPYI has been paying around 49.50 cents on a monthly basis, which is definitely pretty impressive. And for investors that are searching for higher income options, have definitely been pretty satisfied with SPYI so far. Now, just to prove to you guys that the ETFs that I went through in this video are definitely not dividend traps, I want to show you what a $10,000 historically invested into each of these ETFs would return investors over time. So first, for example, SVOL, a $10,000 investment during the inception of the fund would have returned an investor a total return by now around 30.9%, which is an average total return of around 10.38%. Now I get it, there's some investments out there, some different stocks and ETFs that can return much better than 10%, but keep in mind when investing into some of these higher yielding assets, investors are willing to take a little bit of a hit on total return when it comes down to getting massive dividends on a monthly basis. Now for JEPQ, keep in mind again, this ETF is relatively very new, but a $10,000 investment in JEPQ when the fund started would have turned into around $12,000. The average total return on that is around 11.2%. Once again, there's probably better investment vehicles out there, or at least has been historically, for investors to make a bigger total return. But like I said, a positive return of around 10% while getting dividends every single month, that to me is far from a yield trap. Now, the last ETF we went through was SPYI. A $10,000 investment in SPYI would have turned into around $11,500, or once again around a 10.4% return, which is not too shabby at all considering you're getting massive dividends along the way. Now, before we go, I want to show you some examples of what possibly could be considered yield traps, and keep in mind I'm not trying to offend anyone. I personally even own most of these in my portfolios. But one of the most recent yield traps that a lot of investors have been complaining about is ticker symbol TSLY, of course, which has been trading down and down over time, but at the same time offering a massive yield. If we look right here and compare TSLY, which is the ultra high yielding yield max ETF that references Tesla stock, and compare them both as far as total return goes on the year-to-date time frame. So total return is dividends plus price return included. You can see that TSLY is up 63% year-to-date, which I'm not going to lie is amazing. I'd be more than happy to be up 63% year-to-date in my portfolio, so I'm not hating whatsoever. And full transparency, I do own shares of TSLY in my portfolio, at least a few. But during that same time frame, it's no secret that Tesla is up 134%, and that's with paying zero dividend. Tesla has not paid a single dividend on a single month all year long, while TSLY has been paying out monster dividends year to date. Now, once again, I will say, either way, if you're up 63% or if you're up 134% on a year-to-date time frame, I'm personally not going to judge, and I personally would not complain if that was my portfolio. But it still does beg the question of if or if not these super ultra high yielding ETFs are even worth investing into in the first place, or if a lot of times you are better off just investing into the underlying, which in this case, of course, is Tesla stock. Another dividend yield trap that a lot of investors are not too happy with is QYLD, which also offers around, say, 9 to 11% yield, but is trading down around 28% since inception. So now that we went over 3 different high-yielding dividend ETFs, what is your number one favorite high-yielding dividend ETF that you would not consider a yield trap? Drop it in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.